All right, let's get right into it. There is a huge new law that's about to shake up how millions of us file our taxes. It's officially called the One Big Beautiful Bill Act, and believe me, it could mean some really big changes for your personal tax return starting in 2025.
So, this is really the big question, isn't it? Are you potentially leaving money on the table? With a bunch of new deductions coming, knowing exactly what you're eligible for is, well, more important than ever. Let's make sure you have all the info you need.
So this new law, which was signed on July 4th, 2025, it rolls out a whole bunch of new financial benefits for taxpayers, but, and this is a big but, they're temporary. The key word to remember here is temporary, and we are definitely going to circle back to why that is so crucial later on. Okay, so what does this whole thing actually look like when you zoom out? Before we get into all the nitty-gritty new deductions for specific people, let's start with the foundational change that's going to affect pretty much everyone, the standard deduction. Now, take a look at these numbers. What you're seeing here is a pretty clear inflation-adjusted jump. So for the taxes you file for 2025, a single person's standard deduction is $15,750. But look at 2026. It bumps up to $16,100. And you see similar increases for married couples and heads of household. What this really means is that more of your income is shielded from taxes right off the bat. This timeline is super important because it really hammers home just how temporary this all is. The new rules start for the 2025 tax year, which is the return you'll actually file in early 2026. But the date you've really got to circle on your calendar is 2028. That's when all of this is scheduled to just poof, go away. So it's more of a short-term boost, not a permanent change to the system. Okay, let's move on and see how this gets even better for some specific groups of workers. The Act creates two really powerful new deductions aimed squarely at people who earn tips or work overtime. So as you can see, the law basically creates two separate breaks. For anyone earning tips, there's a new deduction for up to $25,000 in qualified tip income. Then, for overtime, you can deduct the premium part of your pay, the half in time and a half, up to $12,500. Now, for both of these, the benefit starts to phase out once your income gets over $150,000 if you're a single filer. Okay, you're going to see this acronym MAGI pop up a lot with these new rules. It stands for Modified Adjusted Gross Income. Basically, it's just your total income minus a few specific things. That number, not just your base salary, is what the IRS is going to look at to see if you qualify for these new deductions we just talked about. Next up, let's talk about a really significant new benefit that's specifically for senior citizens. If you're 65 or older, this is definitely something you'll want to lean in for. The law actually carves out a brand new deduction, and it's designed to give some extra financial relief to seniors. And that deduction is for $6,000. And this is the best part. It's per person. This is an additional deduction. That means it stacks right on top of the regular standard deduction and the extra deduction seniors already get. So it's like a third layer of tax savings, and you can get it even if you don't itemize. So let's quickly break down the rules here. If both you and your spouse qualify, that's a combined $12,000 deduction. Wow. And like we just said, no need to itemize to claim it. The main thing to keep an eye on is the income limit. The phase-out starts for single folks with a MAGI over $75,000 or $150,000 for joint filers. All right, let's shift gears, literally, to the final new deduction. This one is for anyone out there who's even thinking about buying a car sometime soon. $10,000. That is the magic number here. So for the first time for a lot of people, you might actually be able to deduct the interest you pay on a car loan, and you can deduct up to $10,000 a year. I mean, this could seriously lower the real cost of financing a new car. But hold on, it's not for every single car out there. You've got to meet 3 key tests. First, the loan has to be taken out after December 31st, 2024. Second, the car's final assembly point has to be in the United States. And third, it's got to be for personal use, not for your business. And there are just a couple more really important details you gotta know. First off, this doesn't work for leases. Sorry. You also have to include the car's vehicle identification number, the VIN, on your tax return. And finally, just like the others, watch out for that income phase-out, which for this one starts at $100,000 for single filers. Okay, I know that was a ton of information, so to make it way easier to see how this all fits together for you, we put together a final summary. Think of it like a cheat sheet for this whole new tax law. All right, this slide right here puts everything in one place. You can see every new deduction we've talked about, from that $6,000 bonus for seniors to the $10,000 for car loan interest. And just as important, you can see how the income limits compare for each one, because they do vary quite a bit. Seriously, take a second with this one. This is the slide to screenshot or bookmark as your go-to reference.
But as we wrap this up, I want to bring us back to this timeline one last time because this part is just so important. Remember, every single one of these changes, the higher standard deduction, the new breaks for workers, for seniors, for car buyers, they are all, as of right now, scheduled to just vanish after 2028.
And that leaves us with the million-dollar question, doesn't it? These temporary tax breaks create a huge financial cliff in 2028. So what happens then? Will they be extended, made permanent? Or are taxpayers going to see a sudden, sharp tax hike when they just disappear? That is the question that's going to dominate the conversation for the next few years.